Hi everybody, welcome to the Bullish Bears strategy channel. I'm going to go over strategy channel. I'm going to go over a quick option strategy that actually does very well with really high percentage returns on a budget. It's a really interesting way to do things, and now there's been some changes in the market structure that have kind of allowed this to happen, and I've been trading these for a few weeks now, and they're very, very, very fruitful. Recently, both SPY and QQQ have added 2 extra expirations on options. They already had Monday, Wednesday, and Friday expirations. They added Tuesday and Thursday, making it so there's an option expiration every day of the week. At first, this kind of put the damper on the volatility for trading single leg options. Made it a little bit more risky. You had to put your bracket in probably closer to the money, and you end up risking a little bit more than I like to risk as far as single options trades go. But it opened up a world of greatness for really narrow debit spreads. And I've been trading both call and put debit spreads, kind of playing with the sweet spot for how I can figure out where the best risk to reward ratio happens to be. And I discovered that with spreads, it doesn't necessarily matter. In fact, less is more. Let's dive right into a screen. I can show you a little bit more about this strategy. So we're looking at the options chain for December 9th, and that is this Friday. Today is the 7th. And I traded these overnight. Closed about 3/4 of the position yesterday, and then turned it into an existing condor position. I'll explain condors later. Today, let's focus on the debit spreads. So on Monday, I was able to open these while SPY was trading just a little bit over 403 a share, right on this little pop here. And by about the middle of yesterday, I was able to profit half that position at a 600% return. And then I was able to profit another half of the remaining position at an 800% return. Pretty insane, right? Well, actually, it's much more simple than you think. However, there is one caveat. You do want to use a zero commission broker for this, because we're going to be trading such small amount of risk that the fees involved in trading options contracts would kind of dampen the mood, if you would. But I have been consistently making 100% plus returns on these, typically day to day. If price action's flat, I've been able to at least make 100% on them. And if price action gives us a move, like it did, gave us quite the move, these become very, very profitable. Let's get into it. So what I opened on Monday was a spread position, a dollar-wide spread, and I used the 381, 382 puts. I bought the 382 put to open and sold the 381 put to open. And what that does is it kind of sets up a net. You can never make more than the width of the spread in this position. It's a debit spread. And at the same time, your maximum loss is whatever you pay for it in premium. At this time, I paid literally a penny, which equates to a multiple of 100. Becomes $1, a $1 risk. Really, legitimately $1 per contract spread. And I trade these by the hundreds because they're just ridiculously easy. So I wouldn't recommend doing that with a brand new account or a small account. Get a feel for these, 1 or 2 at a time, whatever. Make some wise decisions when it comes to risk management. But I'm going to go through the gist of it and explain this. So the bid ask is where the money is, and these are only $1 apart. They're 1 strike apart. Doesn't matter what the delta is. Really, it matters that the delta is different between the two. So looking at the risk, I would buy this 382, and if I was to open this today, I'd currently have to pay the ask at 23, and I would have to sell to open the bid at 17. That would be a high risk. When I opened these on Monday, I risked $1 between these two, and if you look down the chain, you'll see that a lot of these become $1 apart. So when price moves towards them, they exponentially get bigger and bigger differences between the two, because the delta on the long side goes up faster than the delta on the short side. That is how a debit spread works. So does the premium. And essentially now I'm at still with a quarter of this position open. I have long at 22, which I would have to sell to close to the bid at 21. And just now 22 on this is a live chart. And the 381 I'd have to buy to close at 18. That's a difference of $4. My $1 just made $3 profit, and I'm still holding this. Yesterday when I closed half this position at 600%, I was able to close half that position selling this spread at $7. That is a miraculous percentage for returns with such a little risk, but it is possible. And yesterday at the time I sold for an 800% return, I sold this spread at $9. That's how quick and easy these spreads can be. All you need to do is get the direction right. And even if you don't, you're risking $1. More than likely, if price went flat into the next day, I probably would have at least got my dollar back and been able to roll these out to another date of expiration. Typical expiration times on these, you want to go with entering them at 3 to 5 days to expiration. That's business days, not including the weekends. And when you get the move right, realistically, anywhere from a $3 to $5 move in the price on SPY is going to get you a significant return on these. Effectively, a $5 move is ideal, but in this case, we got quite the move. We got almost $10 yesterday. We got about a $9 move from open to close, and today they're still very profitable. So effectively, it's a percentage game. You'd never want to hold these longer than you have to. A day or two is fine. I could actually hold these into tomorrow as long as I was able to close them probably in the morning. If price continued to go down, I would still be in a massive amount of profit percentage-wise. There is no magic formula. I just like to look for whatever set of strikes happens to be at about $1 risk, buying to open one and selling to open the other. In layman's terms, you really don't have to care about much of the rest of the delta or the data. All you need to know is what the risk and premium is. And even if you were able to close these at $2 and paying $1, that's 100% return. Whether you're day trading them or holding them overnight. They don't have to move much to achieve that, actually. Literally $1 or more move in price on the underlying was enough to do that. I could have closed these the day I opened them for 100% return, literally 15 to 20 minutes after I opened them. That's how quick this stuff moves. So, of course, operate these things with limit orders, both opening and closing, and always pay attention to what you're looking at further down the chain. So if price is moving away from you, you got to realize that at some point, these will become fairly low in value between each other. And it doesn't take a whole lot of move against you to do that, but for the most part, you can see your max loss is still only going to be $1, but in most cases, if it moves just a little bit, you'll still be able to get your dollar back. Like right here between the 379 and 380 puts as an example, you'll be able to get your dollar back. Here you would have made 100% profit, 380, 381. So you really don't have to be dead on with what strikes to pick. You just have to get the direction right, and you have to find the risk to reward ratio that suits you. In some cases, when there's higher volatility but less price action, you might end up having to risk $2 to open this position or $3 to open this position. I would not want to exceed $5 risk in these positions with even with a zero commission account, because there's not a whole lot of room for growth here. And of course, I'm not ever expecting to make max profit on these. I am a percentage guy. I trade to make percentage returns, and this is a really easy way to do it. Even if you're brand new at options combinations, this is an amazingly very inexpensive way to cut your teeth on that strategy, so to speak. So definitely something you want to at least try. I definitely condone doing your own due diligence, making sure you take into account all your expectations of price action and movement, but certainly worth a try. I mean, even if you open an account with $5 like I did several years ago, This is something you can trade for a $1 risk on a very small account, and at least understand how it moves and understand that you're not looking to take max profit on these. You're just looking at percentage returns. And the old adage goes, if you would take the difference between being paid a dime a day or having a penny that doubles every day, which one would you choose? Well, through the power of compounding, that penny that doubles every day is going to grow an account very, very rapidly. Not kidding. Anyway, thought I'd just put together a quick strategy video on debit spreads. This is a quick way to trade them. Certainly the same thing works for call debit spreads. If you expect price to go up, you can do exactly the same thing. 3 to 5 days to expiration. You're looking to day trade or swing trade these things. Pay attention to PDT. Each of these spreads counts as one trade in a direction change. So whether you buy 1 or 1,000 of these to enter and you sell them the same day, as long as they all go in the same order, that counts as one day trade. So you're not going to hurt yourself if you are under the PDT rule, as long as you don't exceed the number that they allow you to do in a given week. Well, that is all for today. Have a wonderful afternoon, everyone. And again, just be very, very knowledgeable about these strategies without having to get into so many details that you're overwhelmed. Really just keep it simple. Have a great one, guys. Bye.